Sure, ma'am.
Can you see the PPT?
Yes, ma'am. Now it's come.
So, last class, what we have done, wherever you are not, I'm not audible, any interference is there, interruption is there, you will tell me if there was with, okay? So,
Okay.
this is what we have already covered. Market value, features of bond, and wherever no, you will interrupt. This difference between your stock and bonds. Similarly, we have done different types of bonds. Then different type of bond included your three major type of bond, which is bond with maturity, pure discount bond, okay, and then your perpetual bond, pure discount bond, which does not give you any interest rate. So it is known as zero coupon bond. And then you have your perpetual bond, and all the calculation we have seen last class, how to do it. This also we have done yield to maturity, then your yield, present yield. These also we have done. Then yield to call we have done. What then amortization of principals we have done. That means if instead of waiting till the last, the borrower, they amortize the loan. That means pay back the principal every interest period. Then how that will be calculated, that also we have done. Am I audible?
Yes, ma'am. You're audible.
Okay. So this also we have done. So this is the sum we have done last class. Showed you how to do. This is a zero coupon bond. It does not give you any interest rate, and it is redeemed at the end of its maturity period. This is somewhere I talked last. That means bond which is sold at par, above par, and below par. Okay. So when, for example, we have taken this example, but last class I just told you in a hurried way. You can see that if a bond is always sold at a par value. Okay, par value means the face value at the time of when it is issued. So suppose the par value of a bond is 1,000, and the interest rate, that means the dividend it will give, is 4%, which is known as the coupon rate. And then suppose in that case, what is the dividend? Every year you will get what is it is dividend or interest payment. It is $40. Now, if a 4% bond is issued when the market rate of interest is also 4%, suppose in the market at that time, it is the market rate of interest is also 4%. In means that the bond is trading at par. We call it that the bond, that means it is being traded at the par value. Okay, so we call this bond is being traded at par. Now, suppose if the market interest rate falls to 3, then in that case, you see your bond is giving you more higher rate of interest. So what will happen? The price of the bond will increase because now the bond will become more attractive than your market rate of interest. So people will find the bond investment in bond more attractive than the investment in the market at 3%. Similarly, if the market rate of interest increases to 5%, your bond becomes less attractive. So in that case, there is every chance that the people will shift their investment from not investing in the bond, rather to the market, into some other which is giving them higher return. So in this case, the price of the bond has to fall in order to sell at a discount. So why this happens, why there is an inverse relation between the bond prices and the market rate of interest, is what we are going to observe in details now. Okay, so already this you have done perpetual bond, where you know the value of a perpetual bond is interest rate divided by the your rate of interest. This we have already done. So let us do this. Okay, this is the previous slide I have just given you to remind you. Because perpetual bond we have done it earlier, and you know how you are getting the value of a perpetual bond. Whatever dividend you are getting, you are dividing it with the given rate of interest, and this is how you get your value of a perpetual bond. So we are going to solve this question. So can you see the question on the board?
Yes, ma'am.
Visible? The question is visible?
Yes, ma'am, it's visible.
Okay. Now you see what is written in the question. Suppose that a 10% your face value of the bond is 1,000. Okay. So if it is 10%, that means what is the dividend every year? Rate of interest is 100.
100.
So your 100 annual rate of interest is into perpetuity. What is a perpetuity? Annuity, which will with no a maturity period. So your annuity, which has a termination period, every year the value is remaining same. That is what we call as the annuity. When it goes on for an indefinite period without any maturity period, we call it a perpetuity. Now, given the following discount rates, you calculate the value of the bond at the given rate of discount rate. Okay. So how you are going to do this? For the first one, value of the bond, if the market rate of interest is 5. So what will be the value of the bond? Can you calculate? There is no maturity period, remember, because it is a perpetuity. Okay. So your formula is simply your dividend divided by the
The dividend by the
rate
5,
of interest.
like
How much
100
it
by
is?
5.
Yes. So how much it
100
is?
by 5 will be 20, I guess, for the
No,
first
it is
one.
100 by 0. It is 5%. 5% means 0.05 you will take.
Oh, sorry,
Okay.
sorry. Yes, it
So
will
it
be
is 100 by
0.5, right?
0.05. That gives you what?
Mm-hmm.
2000.
Yes, 2000.
Similarly, second one is what? 10 divided by your, 100 divided by 0.01.
1,000 rupees, like 0.1 divided by 0.1, so 1,000.
It is 1,000. So your answers, your answers are, how the answers are. Okay, so answers are,
Yes, from 2000 to 1,000, so it is decreasing with
your
the
values
increase
are
in the rate.
2,000, 1,000, then 667, then 500, 400, and 33. So what I'll do is let's go to the board once. Let me see. Can you see the board, Devasmita?
It's loading right now, actually, ma'am.
Visible, no?
Yes, ma'am. Now it's
Visible. So you see discount rate are given, and this is your value of the bond. Value of the bonds. So what you find is the different discount rate are 5, 10, then 15, then 20, then 25, and these are in percentage. So how you are going to calculate this? This is your 100 divided by this is 0.05. That gives you 2000. Similarly, this is your 100 divided by your 0.01
1.
because this is your 10%. This gives you 1000, and this way it goes. Okay. So I just give you the value 667, then this is your 500, then this is your 400, and this is your 333. And what you observe here is as the market rate of interest is increasing, your bond value is declining. If you observe, so you have an inverse relationship between your market rate of interest and the bond value. Okay. So moving on. So now let us go down. So what you observe here, if you are plotting the bond values, if you are plotting the bond values against the your interest rate in the market, which is the market interest rate. So what you get is, for example, at 5%, suppose this is your how much? 2,000. Okay, this is here say 2,000. Similarly, at 10%, it is your 1,000. And this is how you get a plot like this. So this is the inverse relation between your bond values or the your value price of the bond and the rate of interest. This is what we marked here. So let us move on to the PPT. Are you able to see the PPT now?
No, ma'am, not yet. We
No, no.
still see the board.
So I think I have to. You able to see the PPT now?
Yes, ma'am. Now it is. Oh, wait,
Yes,
no. Still, it's saying
yes.
preparing
So
your whiteboard.
board or PPT?
Board, ma'am.
Board only.
Yes, ma'am. At least in my one, it is showing. Now board is gone, but no PPT.
See the PPT now? Devasmita?
No, ma'am. But actually, na, maybe this is a problem on my end because here there is a storm going on. So if anybody else can also confirm, then that would be good.
No, no,
Like the
not
Wi-Fi
for
is very
that.
unstable in this.
Not for that. Now you can see. Visible, no?
Okay, yes, yes. Now
Yes,
it's
because if now opening
showing.
the board, that is
That
going
was
on.
a
Okay.
lag.
So now
Right,
you
right,
see,
right.
let us proceed. This way we have to switch over. So what you see, observe now that there is a negative relationship between bond values and the market rate of interest. So one is high, the other is low, and vice versa. Okay, this is just what we observe. So this you can see that the value of the bond depends upon the market rate of interest, and it varies with the varying rate of interest. So whenever there is a what you observe is inverse relation. If the market rate of interest is high, then the value of the bond will decline. Okay, so because you know that market rate of interest is giving you higher rate of interest, very less people will be interested to invest in bond. At that time, it has to sell below the par value so that some investment may be there, and so on. Okay, so this variation in the rate of interest is what is it is doing is it is making the bond the price of the bond vary, and this is what is known as the interest rate risk. So if there will be a variation in the rate of interest, market rate of interest, your bond values will fluctuate very rapidly, and this is what is known as the interest rate risk of to a bond. So moving on, say well, for example, in that same example, you can see if the rate of interest was falling to 15%, your bond value was 667. Again, when it increased to 25, your bond value further fell to 333, and so on. So now it does not only depend upon the market rate of interest, it also depends upon your terms of maturity. Okay, because now what you saw, it is being exposed to the interest rate risk. Now if the period of maturity is a longer period, in that case you are more exposed to the interest rate fluctuation. Suppose you have invested in a bond which is only for 1 year, so within 1 year maybe some fluctuation in the interest rate may be there, may not be there. But if it is 10-year bond, obviously you can expect the interest rate to be fluctuating many times. Okay, so that is what makes the valuation of bond very sensitive to not only the rate of interest but also to your maturity period. Here in example B, we have taken a different discount rate, and now we have varied it between different, we are going to evaluate it between different years. For example, we are going to take 5-year bond, 10-year bond, and then a perpetual bond, which don't have a maturity period. So if it is a 5-year bond, how do you calculate the bond price? Is the same. Your perpetual bond, par value is given as 1000. So if the discount rate is 5%, what will be the value for the first year for a 5-year bond?
1000 by 0.05, which
Remember, this is not a perpetual bond. Okay, it is 5-year bond. So if it is a 5-year bond, what is the cash flow from this bond? What you will get from this bond? One is your dividend every year for 5 years, isn't it? Then at the end of the 5 year, what you are going to get is the bond value, the principal amount, which is your par value. This is the flow from the bond. Am I clear?
yes, ma'am.
Okay. So what we are going to do is we are going to solve this. You can see the board.
Yes, ma'am. We see the board.
Okay. So now see how we are going to solve. This is your discount rate. Discount rates. And these are different time period given. 5-year bond. This is 10-year bond. And this is your perpetual bond. Perpetual bond. So for 5 years bond, if the discount rate is 5, then similarly we'll calculate for 10. Then this is for 15. Then only a few, let us do for 20. Many are there, you can do it afterward. Let me show you this much. So what you see for 5-year bond, when this is 5 years, and what will be the cash flow from this bond? One will be the dividend, which is your 100 for 5 years. And after that, you will have the principal amount. So if you are going to calculate this, I'm going to first calculate this part here. Okay. So how you are going to calculate this? You are going to calculate the valuation of the bond. So your bond value will be, B0 will be how much? Your first dividend. Okay. Now remember this will flow for 5 years. The same dividend for 5 years. So you are going to use your fifth formula if you remember. P given A, I for your discount rate is 5. For 5 years and 5%. This I is your 5%. And your N is this 5 years. Okay. So along with this, you will get your principal amount at the end, which you have to discount it from the last year. This is your overall payment. So what is your formula? This is your 100. Remember this fifth formula. Your fifth formula was what? 1 plus I to the power n minus 1 by I into 1 plus I to the power n. Okay. Plus this value is there. This is there. So if I solve it, so if I solve it, you will get it as 100. This is your percentage. 1 plus I means at 5%, 1.05. 5 years minus 1. This divided by 0.05. This is your 1.05 to the power n. This part. Plus, this is your 1000, 1.05 to the power 5. So now if you solve, you get this part. I'm just skipping one step. You can do it. Solve this value. So what you are going to get here is, this is 100. This is 4.329. If you solve this bracketed part, plus this is your 783. Your answer is 1216 for the first one. Some decimal difference may be there. You can check your answer. So what you got is 1.16. I'm just showing you the procedure. This is 1.16. Did you get Devasmita?
Yes, ma'am. Doing.
Doing. You can just see. Now if I'm going to solve it here, same 5%, 5-year bond, but now discount rate if increases in the market to 10. If the discount rate, interest rate increases to 10, so you see everything remains same. Instead of 5, I'm going to use 10 now. Same for 5 years, and I'm going to use 10 now. So if I do that, okay, so what I'll get is your 1000. And same, everything for 5 years remaining same. If I do, I'll get 832. You can check it afterward. So yeah, for 10 years, similarly, if I'm solving it for this, then what will happen? 5%. And now it is for 10-year bond. Suppose your bond is maturing at 10 for 10 years. I'm showing you how your bond is sensitive to not only market rate of interest, but also your maturity period. Okay. So now if you are doing this, then what will happen? Your B0 will be your 100. This is your 1.055%. Now time has changed. 10 years bond divided by this 0.05. So this is 1.05 to the power 10. Then plus this is what will happen? 1000 divided from 5% from the 10th year. And you get your value as how much? 1398. Just check it out. Okay. So if I just show you, I've just shown you how to calculate. So if I do it, you get 1386. Similarly, you will get it as 1000. Similarly, you will get it as 749 and so on. And if it is perpetual bond, you know how to do. It is simply 1000 divided by your 5. Similarly, your 100 divided by 0.05. Similarly, your 100 divided by 0.01. You just calculated that for your perpetual bond. So it is 2000, then it is your 1000, then 667 and so on. Did you follow this?
Yes, ma'am.
Okay. Soumyadeep, are you listening? Okay. So not now, I have shown you how to calculate this. So again, what I'll do is, I'll go back to the PPT. Yes. So what we'll do is, we go to the PPT. You can see the PPT, I guess.
Yes, ma'am, we can see.
Okay. Yeah. Now you see, if these are the answers you got. I'll send this PPT, you can try it. These are the answers you got. So what you observe from this is, see, at 10%, you see, if you take 10% as the starting point, all the values are same. 1000, 1000, 1000. As the market rate of interest is increasing, all the bonds, you see, values are declining. Again, what you observe is values are declining, but the decline is more faster for a perpetual bond. Similarly, if it is 10 years bond, decline is also faster. Okay, but less than perpetual bond. And 5 years bond, it is declining, but it is in a better position than your 10 years bond. Why? Because as the maturity period is increasing, you are more exposed to the market rate of interest fluctuation risk. Okay, so the bond values falls at a very fast rate if the maturity period is increasing. So this is what you observe from this. So what you conclude, that two bonds of the same quality in terms of risk, suppose both have the same risk of your default, would have different exposure to the interest rate risk depending upon the maturity period. The one with longer maturity is exposed to greater risk, because suppose it is a 5-year bond. Okay, so what you can do is, after 5 years, you can again get your bond renewed. But if you have taken it at 10%, 10-year bond, in that case, you don't have an option to change, Because till 10 year, even if the market rate of interest increases, you have to do with the same 5 years, you have 5% or 10% rate of interest. You cannot change. But if it is a 5-year bond, you can just dissolve it. And again, if the market rate of interest has increased, you can invest your bond in a 10 or 15% bond. That option will be available to you. But if it is for a longer maturity, you don't have that option. Okay. So this is what you have observed from here. So those 3 bonds are being plotted here. Okay, go through the PPT nicely. Now, what is there? The concept of bond duration and interest rate sensitivity. So what you observe that bond prices are sensitive to the rate of interest. It is inversely changing with the rate of interest. Okay, now how much it is sensitive to the rate of interest again depends upon what is the maturity period of that bond. Longer the maturity period, more is the exposure to risk. Okay, so another thing is, if the bond coupon rate is very low, suppose you have a 5% bond, another is a 10% bond. One is giving you a 5% dividend, another is giving you a 10% dividend. Then the lower coupon interest rate bond will be more sensitive to interest rate fluctuation, because whenever the market rate of interest will increase, lot of sale of that bond will be there. People will try to get rid of that bond, and as the supply of that bond will increase, its price will fall in the market. Did you get my point?
Yes, ma'am.
Okay. So moving on. So what is important is how to know. Suppose you have been given details about 2 bonds. How to know which bond you should invest and which is more riskier. For that, we have a concept which is known as the duration of the bond. Okay. So the bond price sensitivity, what it will measure, it measures the bond's price sensitivity to the market rate of interest, how it is fluctuating. Okay, so how to calculate this duration? This is what we are going to do it. So how you define it? A bond's duration is measured as the weighted average of times to each cash flow. Each cash flow means what is the cash flow from the bond? Your dividend payment as well as your principal payment. So we are going to give different weightage to it and calculate the duration of the bond. The duration in one value will show you how riskier the bond is. Okay, so moving on, these are the 3 steps to calculate the duration of the bond. First is whatever the cash flow given, just now you have done, your dividend plus your principal payment, you find their present value as you have done just now. Okay, now take the summation of this present value. That will be your overall bond value. To give the weightage, what you do is divide each year cash flow with the total value, total summation of this value. Okay, and then multiply the years to get the summation, which is your duration. So we'll solve this. Need not be worried. So whatever the steps you saw, I'm just showed you the steps. Now we are going to solve it. So you may have 2 bonds with the same maturity. Suppose both are maturing for 10 years. Okay, but coupon rate is different. One is giving you say 5%, another is giving you 7% dividend. Okay, so they will have different duration. Their duration will differ. Duration means how risky it is, how volatile it is. This is what we are going to do. Another term we are going to calculate is the volatility or the interest rate sensitivity of the bond, which is given by the duration of the bond and its yield to maturity. So this will be the formula for volatility. So for every bond, we are going to calculate, suppose you are given different bond, we are going to calculate what is the duration of the bond and then what is the volatility. That means which bond is more riskier than the other. This is what we are going to calculate now. If you want, all of you, what you do is you can just take a snap of this. You can take a snap of this. One is this steps. Just take a snap once because we are going to go to the board. Taken? Just take a snap of this. Have you taken? Then take a snap of this formula. And this is what we are going to solve now. Devasmita? Arjun? Am I audible?
Yes,
Am I audible, Somyadeep? Just take a snap of this question and post it in the group.
yes, ma'am.
I think it is already there. QC
Okay,
question
ma'am.
is already there. Yes. So what we can do is go to the board now. Can you see the board? Are you able to see the board?
Yes, ma'am.
Okay. So let us proceed with this. So let us calculate the duration and volatility of the bond. So the duration of bond, this is your question QC. Okay. So duration of bond, the first bond is 8.5%. So it is giving you a dividend of 8.5%. So first is your years. You are going to calculate it for 5 years. It is given for 5 years in the question. Okay. So first is what are your cash flow? If it is 8.5%, so your dividend, this is your cash flow. Your cash flows are, what cash flow you will get? First is in year 1, you will get dividend, same dividend. And the last year, what you are going to get is your dividend plus the principal amount. What is 1085? This is what you are going to get. Okay. Second one, what you are going to do, the steps are, you are going to find the present value of this. Say, this is your column 1. And let this be your column 2. Okay. So what you are going to do is find present value of your cash flow. Present value of the cash flows. So if you do that, what you are going to do is, 85, discount rate, discount the values. Are you listening? Am I audible? It is given at 10%. Okay.
Yes, ma'am.
So
Yes.
you are going to discount it at 10%. So 85, 1.10. This is for first year. So your answer is 77.27. Similarly, your second one is 85, 1.10 is the rate of interest.
Whole square.
Discount yes square. Good. So this is your 70.25. So you go on doing that. So you got 63.86. Similarly, the other values you will get is 58.06. Then what you will get is 673.70. You will get. Then what you are going to do is take the summation of this. This is 943.14. Okay. Now your fourth column is you are going to find the or give the weightage. Remember your fourth column is proportion of bond prices. That means you are finding the weightage here, bond prices. So this is the weightage. You are giving weightage to the each year cash flow. How you are going to do is simply divide this with the overall summation. That's the weightage. So it is your 77.27 divided by, this is 943. 943.14. Similarly, 70.25 divided by 943.14. This is how you will proceed. Okay. So this is the values you are getting with this is So the values you are getting with this is equal to 0.082. And this you are getting as 0.074. This you are getting as 0.068. This you are getting as 0.062. Okay. And last one is 0.0714. This is what you are getting. And how you know that your calculation is correct? Because if you take the summation of this, you get it as 1. If you take the summation, you will get it as 1. Okay. Now, what you do is, the last one, you are going to, this is your column 4. So this is column 1, 2, 3. This is suppose column 4. So what you are going to do here is column 4 into time. Multiply with each time period. So this into 1. When you are going to get, because you are giving the weightage to the time period of flow. So this you are getting into 1. If you are doing this, is you are getting as same value 0.082. So this 0.082. Second one, what you are doing is this into 2 you are doing, because second year it is. So you are getting a value of 0.149. And this way you proceed. Okay, this session will get log out in 2 minutes. Join back. Okay. Join back for 5-10 minutes, then we'll wind up. So this is 0.149. Similarly, this you will get as 0.203. This will get as 0.246. This you will get as 3 points. Sorry, this is not 0. So last one is 3.572. So if you take the summation, you get 4.252. And this is what is known as duration of bond with the given details. This is 8.5% bond. Same way you proceed. Okay. Yeah, there is the second bond, which is given duration of bond, and the dividend is given as 11.5%. This is 11.5%. And you will get the duration. Same way you will proceed with all the steps. And you will see that the duration you get of this bond is, you are getting as 4.086. After getting the duration, what we are going to calculate is volatility. Okay, so bond duration gives you how sensitive it is to the market rate of interest. Now, how volatile, how risky it is as the time period is increasing, that information will be given from its volatility calculation. So we are going to calculate the volatility of the bond. So if before I finish calculating the volatility, it goes off, you will join back. Okay. Now let us say that the volatility, how we are going to calculate. So its formula is given as your duration divided by 1 plus your yield to maturity. Yield to maturity means the rate of interest which has been given for each bond. Okay. So in the first bond, for 8.5% bond, what was your duration? 4.252 divided by your 10% is given. That means your 1.00. And you got it, volatility is 3.87. 3.87. And for the second bond, 11.5%